Something remarkable is happening in the bond market right now that most investors are completely missing. Pension funds, insurance companies, and sophisticated institutional investors are buying 30-year Treasury bonds at a pace I haven't seen since 2008. Not because they're desperate, not because they're making defensive moves ahead of a crisis, but because they see an opportunity that comes along maybe once or twice in a generation. The chance to lock in 4.5% risk-free returns for 3 decades. And retail investors, the people who actually need this opportunity most, are ignoring it completely. They're still chasing stocks, still buying real estate, still looking for the next hot investment while the smartest money in the world is quietly accumulating the safest, most reliable return stream available. In 5 years, when Treasury yields are back at 2% or 3%, today's decision to buy or not buy 30-year bonds at 4.5% is going to look like either brilliant foresight or a catastrophic missed opportunity. Before we go further, I'd appreciate it if you could support this content by liking the video and subscribing to the channel with notifications enabled. It helps us continue bringing you this kind of analysis. I need to be very direct with you about something that's bothering me. I've spent nearly 50 years in finance. I run BlackRock, where we manage over $11 trillion in fixed income and equity assets for clients around the world. And I watch market dynamics every single day, not just what's happening, but what different types of investors are doing and why. And right now, I'm seeing one of the most dramatic disconnects between institutional behavior and retail behavior that I've witnessed in my entire career. Institutional investors, the pension funds managing retirement money for millions of workers, the insurance companies with multi-decade liability horizons, the endowments funding universities for generations, they're loading up on long-duration Treasury bonds. Not tentatively, not as a small tactical position. They're making substantial, strategic allocations to 30-year treasuries at current yields around 4.5%. Meanwhile, retail investors, individual people managing their own retirement accounts, their own brokerage portfolios, their own financial futures, are almost completely absent from the long-duration treasury market. They're buying stocks, they're buying ETFs, they're buying real estate, they're holding cash in money market funds. They're doing everything except the one thing that institutional investors with vastly more resources and sophistication are doing aggressively right now. And the question I keep asking myself is, why? Why is there such a dramatic divergence in behavior between the money managed by professionals with fiduciary obligations and deep analytical resources, and the money managed by individuals for themselves? Because usually, when institutional investors move decisively in one direction, they're seeing something that individual investors should probably pay attention to. Let me start by explaining what's actually happening in the bond market and why it matters. Then I'll explain why institutions are buying so aggressively. And then I'll address why I think retail investors are making a significant mistake by ignoring this opportunity. First, the current state of the Treasury market. As of early 2025, 30-year Treasury bonds are yielding approximately 4.5%. That's the interest rate the U.S. government will pay you, guaranteed, for the next 30 years if you buy these bonds today. It's a risk-free return in the sense that the U.S. government has never defaulted on its debt obligations and isn't going to start now. The credit risk is essentially zero. Now, 4.5% might not sound exciting if you're comparing it to stock market returns of 10% or 12% over long historical periods. But context matters enormously. For most of the past 15 years, from roughly 2009 through 2021, long-term Treasury yields were between 1.5% and 3%. There was a brief period in the mid-2010s when the 30-year yield got to 3.5%, but that was an outlier. The prevailing rate environment was deeply suppressed because of Federal Reserve policy, quantitative easing, zero interest rate policy, all the post-financial crisis interventions. During that entire 15-year period, institutional investors were desperate for yield. They were buying corporate bonds with credit risk to get 4% or 5%. They were buying emerging market debt with currency risk and sovereign risk to get 6% or 7%. They were buying mortgage-backed securities with prepayment risk. They were stretching for yield anywhere they could find it because Treasury yields were so low that they couldn't meet their return targets with risk-free assets. And now, for the first time since before the financial crisis, you can get 4.5% risk-free for 30 years from U.S. Treasury bonds. The Fed raised rates aggressively in 2022 and 2023 to fight inflation. Short-term rates went above 5%. Long-term rates followed, though not as dramatically. And even though the Fed has started cutting short-term rates from their peak, long-term treasury yields have remained elevated relative to the past 15 years. This is the opportunity for investors with long time horizons, and if you're in your 40s, 50s, or early 60s planning for retirement, you have a long time horizon. You can lock in 4.5% guaranteed returns for 3 decades. And institutions see this for what it is: a structural shift in the yield environment that creates opportunities that didn't exist for the entire post-financial crisis era. Let me explain why 4.5% for 30 years is compelling from an institutional perspective, because this is where retail investors often misunderstand fixed income investing. Institutions don't think about bonds the same way they think about stocks. With stocks, you're looking for capital appreciation, earnings growth, multiple expansion. With bonds, especially long-duration treasuries, you're thinking about 3 things: guaranteed income, duration matching for liabilities, and total return in different economic scenarios. Start with guaranteed income. A pension fund knows it needs to make payments to retirees for the next 30 years. An insurance company knows it needs to pay claims and annuity obligations for decades. These are predictable, long-term liabilities. When you can buy a 30-year treasury at 4.5%, you're locking in the cash flow needed to meet those liabilities with zero default risk. That's enormously valuable for institutions with defined obligations. But here's what many people miss: the total return potential of long-duration bonds when interest rates fall. If you buy a 30-year treasury today at 4.5% and interest rates drop to 3% over the next few years, which is entirely plausible if inflation continues moderating and economic growth slows, the market value of your bond increases substantially. Not slightly, substantially. The mathematics of bond pricing are such that when yields fall on long-duration bonds, prices rise dramatically because you're discounting decades of future cash flows at a lower rate. A rough rule of thumb: for a 30-year bond, a 1% decline in yield produces approximately a 20% increase in price. So if you buy at a 4.5% yield and yields fall to 3.5%, your bond is worth roughly 20% more than you paid for it. That's a 20% capital gain on a safe government bond, plus you're collecting 4.5% annual interest the whole time. This is why institutions are buying aggressively. They're not just locking in 4.5% yield. They're positioning for potential capital appreciation if, and I'd say when, long-term interest rates decline from current levels. They're getting paid to wait, and if rates fall, they get a substantial capital gain on top of the income. Now let me explain why I think rates are likely to fall over the medium term, because this is the analytical foundation for why this opportunity exists. Interest rates are determined by several factors: Federal Reserve policy, inflation expectations, economic growth expectations, supply and demand for credit, and global capital flows. Let's walk through each. Federal Reserve policy. The Fed raised rates dramatically in 2022-2023, taking the federal funds rate from near zero to over 5% to combat inflation. But inflation has moderated significantly from its peak above 9% down to around 3%. The Fed has already started cutting rates from the peak. Current market expectations are for further cuts over the next 12 to 24 months as inflation continues normalizing. When the Fed cuts short-term rates, long-term rates typically follow, though not one for one. Inflation expectations. Long-term inflation expectations, as measured by surveys and inflation-protected securities markets, are anchored around 2% to 2.5%, close to the Fed's 2% target. If inflation expectations remain contained, there's no reason for long-term Treasury yields to stay at 4.5%. A 4.5% nominal yield with 2% inflation is a 2.5% real yield, which is historically high for long-term Treasuries. Over the past several decades, real yields on long-term treasuries have averaged closer to 1% to 1.5%. Economic growth expectations. The U.S. economy is slowing from the post-pandemic surge. Growth rates are moderating. Labor markets are cooling. Consumer spending is normalizing. Nothing catastrophic, but we're moving from above-trend growth back toward trend growth. In that environment, credit demand typically moderates, which puts downward pressure on interest rates. Global capital flows. The U.S. Treasury market is the deepest, most liquid, safest bond market in the world. When there's uncertainty anywhere globally, geopolitical tensions, financial stress, economic slowdowns, international capital flows to U.S. Treasuries as a safe haven. We've seen this pattern repeatedly over decades. And right now, there's plenty of global uncertainty. Conflicts in Ukraine and the Middle East, economic challenges in China, political transitions in Europe. All of this supports demand for treasuries, which supports prices and lowers yields. When you combine all these factors, the base case for long-term treasury yields over the next 3 to 5 years is lower than today's 4.5%. Maybe they go to 3.5%. Maybe they go to 3%. Maybe, if we have a recession or significant financial stress, they go back to 2.5% like they were for much of the 2010s. The exact level is unknowable, but the direction, lower, is highly probable. And if I'm right about that direction, buying 30-year treasuries today at 4.5% is going to look brilliant in hindsight. You locked in a yield that won't be available at these levels for long, and you captured capital appreciation as yields fell. Now let me address the counter-argument, because I know some of you are thinking, Larry, what if you're wrong? What if inflation comes back? What if rates go higher instead of lower? Then I'm stuck in a 30-year bond earning 4.5% while inflation is running at 6% or 7%. That's a terrible real return. This is a legitimate concern, and it's the primary risk of buying long-duration bonds. If inflation surges and interest rates rise significantly, the market value of your bonds will fall, and you'll be earning a negative real return. This is what happened to bondholders in 2022 when inflation spiked and the Fed raised rates aggressively. Long-duration treasuries fell 25% or more in market value. It was brutal. But here's my assessment of that risk right now. It's lower than it's been in years. Inflation has already been fought and is moderating. The Fed has already raised rates and broken the inflation spike. Supply chains have normalized. Labor markets have cooled. Housing cost increases have slowed. The conditions that created 9% inflation in 2022 don't exist anymore. Could there be another inflation shock? Yes, theoretically. Maybe there's a geopolitical event that spikes oil prices. Maybe there's a new pandemic. Maybe there's some unforeseen supply disruption. But these are tail risks, not base cases. The most likely scenario is continued disinflation toward the Fed's 2% target, which supports lower interest rates and makes today's 4.5% yield on 30-year treasuries attractive. Moreover, even if inflation does tick up modestly, 4.5% is still a reasonable real return if inflation settles at 2% to 2.5% long-term. You're getting 2% to 2.5% real return with zero credit risk. Historically, that's good. Not spectacular, but solid and reliable. So when I balance the probability and magnitude of different outcomes, rates going lower versus rates going higher, the risk-reward of buying long-duration treasuries at current yields is favorable. The upside scenario, rates fall, you get capital gains plus income, is more probable and potentially more rewarding than the downside scenario. Rates rise, you suffer capital losses and low real returns. And institutions, which employ armies of economists and strategists and risk managers to analyze exactly these questions, are clearly reaching the same conclusion. Because they're buying. Not hedging. Not waiting. Buying. Now let me address why retail investors are largely absent from this trade despite the compelling opportunity. I think there are several reasons, and they're all rooted in behavioral biases and structural features of how individual investors make decisions. First, recency bias. The last few years have trained investors to expect low returns from bonds. From 2009 to 2021, bonds yielded almost nothing. Investors who bought long-term treasuries at 2% or 2.5% did fine on price appreciation as rates fell even further, but the income component was terrible. And in 2022, bonds got crushed when rates rose. So investors have internalized the lesson. Bonds don't pay enough and they're risky when rates rise. They've written off the asset class. They're not even checking what current yields are because they assume they're still unattractive. Second, equity bias. Retail investors are disproportionately focused on equities because that's where the exciting stories are, where the big returns happen, where you can feel smart if you pick the right stock or sector. Bonds are boring. They're not topics of conversation. There are no Tesla or Nvidia equivalents in the treasury market. So psychologically, investors gravitate to stocks even when the risk-reward might favor bonds. Third, lack of understanding of bond math. Most retail investors don't understand duration, convexity, yield curves, or how bond prices move inversely to interest rates. They think of bonds as safe, in the sense of stable value, not understanding that long-duration bonds can be quite volatile in price even though they have no credit risk. So they either avoid bonds entirely because they don't understand them, or they buy short-term bonds or bond funds and miss the opportunity in long duration. Fourth, financial media emphasis. Turn on any financial news channel and 90% of the coverage is about stocks. What stocks are up, what stocks are down, what's driving tech or energy or whatever sector. Bond market coverage is minimal and technical. So investors aren't even aware that there's an opportunity in treasuries because nobody's talking about it in accessible ways. And fifth, advisor incentives. Many financial advisors are compensated primarily on assets under management in equity and balanced portfolios. There's less incentive to move clients into individual treasury bonds, which are commoditized and low margin, versus keeping them in managed equity or balanced funds that generate ongoing fees. So advisors aren't proactively recommending long-duration treasuries even when they make sense. All of these factors combine to create a situation where institutions are buying aggressively and retail investors are sitting on the sidelines. And this divergence, in my view, is a mistake that retail investors will regret. Because here's the reality. Most individual investors need the stability and guaranteed return that long-duration treasuries provide more than institutions do. Institutions have diversified portfolios across dozens of asset classes. They have professional risk management. They can weather volatility. Individual investors typically have smaller portfolios, less diversification, less ability to withstand losses, and more need for predictable income in retirement. A retiree with $1 million who can lock in 4.5% risk-free for 30 years is generating $45,000 annual income with zero default risk. That's life-changing financial security. And if rates fall and the bonds appreciate in value, that's a bonus. But the core value is the guaranteed, stable income stream that lasts for decades. Yet that same retiree is more likely to have their money in a 60/40 stock bond portfolio or an all-equity portfolio because that's what conventional wisdom and financial advisors have told them to do for years. And they're missing the opportunity to lock in returns that won't be available at these levels once the yield environment normalizes. This is what I mean when I say institutions are seeing something retail investors are missing. It's not that institutions have secret information. It's that they're analyzing the current opportunity set rationally, without behavioral biases, and concluding that long-duration treasuries at 4.5% represent exceptional value for long-term, risk-averse investors. And retail investors, who should be the natural buyers of that value, are ignoring it completely. In 5 years, when 30-year treasuries are yielding 3%, people who bought at 4.5% are going to look prescient. And people who stayed in cash or chased stocks through another market cycle are going to wonder why they missed such an obvious opportunity. That's the divergence I'm trying to highlight. That's the decision that's being made right now, whether people realize it or not. Let me walk you through how to think about incorporating long-duration treasury bonds into a portfolio, because this isn't about going all in on one asset class. It's about strategic allocation based on your time horizon, risk capacity, and income needs. And it's about understanding the specific role that different bond maturities play in a comprehensive wealth-building strategy. Start with the fundamental question. What are you trying to accomplish with your fixed income allocation? Different investors have different objectives, and those objectives should drive allocation decisions. Let me outline several scenarios. Scenario 1. You're 55 years old, planning to retire at 65, with a $2 million portfolio. You're currently 70% stocks, 30% bonds, which is reasonably appropriate for someone 10 years from retirement. But within that 30% bond allocation, $600,000, how should you structure it? The traditional approach would be intermediate-term bonds or a bond fund with average maturity of 5 to 7 years. This provides some income, some stability, and moderate interest rate risk. But here's an alternative worth considering. Ladder a portion of your bond allocation into long-duration treasuries that mature in or near your retirement years. For example, take $200,000 of that $600,000 bond allocation and buy 30-year treasury bonds today at 4.5%. In 10 years, when you're 65 and retiring, those bonds will be 20-year bonds. If interest rates have fallen as I expect, those bonds will be worth significantly more than you paid, maybe $250,000 or $280,000 depending on where rates have gone. And you've been collecting 4.5% annual interest the entire time. Now you have a choice at retirement. Hold the bonds for their continued income stream of 4.5%, or sell them, take the capital appreciation, and reallocate based on your retirement needs. Either way, you've locked in a return that won't be replicable if rates have indeed fallen to 3% by that point. This isn't an all or nothing proposition. You're not putting your entire portfolio into 30-year bonds. You're strategically allocating a portion of your fixed income sleeve to capture an opportunity that exists today but likely won't exist in a few years. The rest of your bonds can be in shorter maturities for liquidity and flexibility. Scenario 2. You're 40 years old with 25 years until retirement, currently 90% stocks and 10% bonds because you're young and growth-oriented. Should you care about 30-year treasury bonds at all? Here's how I'd think about it. Even though you're decades from retirement, you need portfolio ballast for the inevitable periods when stocks decline sharply. In 2022, a 60/40 portfolio fell roughly 18% because both stocks and bonds declined simultaneously when the Fed raised rates. That's unusual. Normally bonds provide stability when stocks fall. But looking forward, if you add some long-duration treasuries now at 4-5%, you're building in a hedge for the next recession or market downturn. When that occurs, and it will occur, we just don't know when, the Fed will cut rates aggressively as they always do in recessions. Long-term treasury yields will fall, and your long-duration bonds will appreciate significantly in value precisely when your stocks are getting hit. So even as a young, growth-oriented investor, having 5% or 10% of your portfolio in long-duration treasuries at today's yields creates asymmetric protection. In normal times, you collect 4.5%. In crisis times, when correlations break down and stocks crater, your treasuries potentially double in value as a flight to safety drives yields down to 2% or lower like they did in March 2020. This is how institutions think about long-duration treasuries, not as a return-maximizing asset, but as a genuinely uncorrelated, crisis-performing asset that provides balance and protection that's worth having even in growth-oriented portfolios. Scenario 3. You're 70 years old and retired with a $3 million portfolio generating income for your living expenses. You need approximately $120,000 per year after tax to maintain your lifestyle. How do long-duration treasuries fit? In this scenario, you need to balance income generation, capital preservation, and longevity risk. You might live another 20 to 25 years. Your portfolio needs to last that long and ideally grow modestly to keep pace with inflation. Here's a structure to consider. Take $5 million, half your portfolio, and create a treasury ladder. Buy 30-year treasuries, 20-year treasuries, 10-year treasuries, and intermediate treasuries in roughly equal amounts. This gives you staggered maturities, reducing reinvestment risk, while locking in current yields across the curve. The $1.5 million in treasuries at an average yield of roughly 4% generates $60,000 annual income with zero credit risk. The other half of your portfolio can be in dividend-paying stocks, REITs, or other income-oriented assets that provide the additional income you need plus some growth potential. This structure gives you a stable income base that doesn't depend on market performance, which is psychologically valuable in retirement. And critically, the long-duration portion of your treasury ladder, the 30-year bonds, provides appreciation potential if rates fall, which gives your portfolio some growth even in the safe allocation. This addresses longevity risk better than sitting entirely in short-term bonds or CDs that have no price appreciation potential. Now let me address the mechanics of actually buying treasury bonds, because I think confusion about how to do this prevents some investors from taking action. There are three main approaches: buying directly through Treasury Direct, buying through a broker, or buying treasury bond funds or ETFs. Treasury Direct is the U.S. government website where you can buy treasuries directly at auction with no fees or commissions. It's straightforward but requires setting up an account, navigating a somewhat clunky interface, and managing the bonds yourself. You buy at auction, hold them, and collect interest electronically. At maturity, you get your principal back. Simple but manual. Buying through a broker, Fidelity, Schwab, Vanguard, whoever you use, is more streamlined. You can buy treasuries in the secondary market at any time, not just at auctions. You can see the current yield, the maturity date, the price. You buy it like you'd buy a stock. The broker holds it in your account, credits interest payments, handles reinvestment if you want, and settles at maturity. This is how most sophisticated individual investors buy treasuries. Treasury bond funds or ETFs, like TLT, the iShares 20-plus year Treasury Bond ETF, or EDV, the Vanguard Extended Duration Treasury ETF, provide instant exposure to long-duration treasuries without buying individual bonds. You get diversification across multiple maturities, professional management, daily liquidity, and automatic reinvestment of interest. The downside of funds versus individual bonds is that funds don't have a maturity date. If interest rates rise and the fund value declines, You don't have the option of just holding to maturity and getting your principal back like you would with an individual bond. You're subject to ongoing mark-to-market volatility. For some investors, this is fine. They're comfortable with the volatility and value the liquidity. For others, especially retirees who want to hold to maturity and collect steady income, individual bonds are preferable. My general recommendation: if you're building a long-term position you plan to hold for years or decades, buy individual bonds. If you're making a tactical allocation you might adjust over time, use ETFs for flexibility. Now let me talk about the yield curve and why it matters for understanding the opportunity in long-duration treasuries. The yield curve is simply a graph of treasury yields across different maturities. Normally, it's upward sloping. Longer maturities pay higher yields than shorter maturities because you're taking more risk by locking up your money longer. As of early 2025, the curve is relatively steep. The 2-year treasury yields around 4.2% and the 30-year yields around 4.5%. That's only a 30 basis point premium for extending duration from 2 years to 30 years. Historically, that's a very flat curve, which tells you that the market doesn't expect much inflation or growth over the long term. But here's what's interesting. Even though the curve is relatively flat, the absolute level of long-term yields is elevated compared to the past 15 years. So you're getting 4.5% on 30-year bonds in an environment where the market is pricing in relatively benign long-term conditions. That's the sweet spot. If the market were pricing in high long-term inflation or strong growth, the 30-year yield would be 6% or 7% and you'd worry that you're locking in a rate that will look terrible when inflation runs hot. But at 4.5% with a relatively flat curve, the market is essentially telling you that long-term conditions will be moderate, which means this 4.5% yield is likely to look attractive in retrospect. Think about the scenarios where today's 4.5% on 30-year treasuries turns out to have been a bad decision. You need sustained high inflation, 5% or more for years, or a massive surge in economic growth that drives real rates significantly higher. Neither seems particularly likely given current conditions: inflation moderating, growth normalizing, Fed cutting rates, global demand for safe assets elevated. Contrast that with the scenarios where 4.5% looks brilliant. Recession drives rates to 2%, geopolitical crisis drives flight to safety. Inflation stays contained and real rates normalize lower, aging demographics in developed economies keep long-term rates suppressed. All of these scenarios are plausible, some are probable, and in any of them, you're glad you locked in 4.5%. Let me address another consideration: taxes. Treasury bond interest is exempt from state and local taxes but subject to federal tax. For investors in high-tax states like California or New York, this matters. A 4.5% treasury yield is equivalent to a roughly 5% to 5% fully taxable corporate bond yield for someone in a high-state tax bracket. This tax advantage makes treasuries even more attractive for high-income investors in high-tax states. You're getting a 4.5% yield that's effectively 5% plus after considering state tax exemption, with zero credit risk. Show me a 5% corporate bond with zero default risk. It doesn't exist. Conversely, for investors in states with no income tax, Florida, Texas, Nevada, etc., the state tax exemption doesn't matter. But treasuries are still compelling on an absolute yield basis compared to recent history and relative to the risk. Now let me discuss the role of treasury bonds in portfolio rebalancing and risk management. One of the most powerful features of having a meaningful treasury allocation is that it gives you dry powder when stocks sell off. When you have a disciplined rebalancing strategy, say, rebalance quarterly to maintain target allocations, treasuries become a source of capital to buy stocks when they're cheap. Here's how it plays out. Imagine you have a $1 million portfolio, 60% stocks, $600,000, and 40% long-duration treasuries, $400,000. The market crashes 30%. Your stocks are now worth $420,000. But in that same crisis, treasury yields fall from 4.5% to 2.5% and your long-duration bonds appreciate 40% to $560,000. Your total portfolio is $980,000. You're down 2%. Not down 18% like you'd be in a 60/40ths portfolio with intermediate bonds. Now you rebalance back to 60/40ths. You need $588,000 in stocks and $392,000 in bonds. So you sell $168,000 of treasuries and buy stocks. You're systematically buying stocks 30% cheaper than they were, funded by selling treasuries that have appreciated 40%. This is disciplined, contrarian investing without emotion or timing, just mechanical rebalancing that forces you to sell high and buy low. This is why institutions love long-duration treasuries. Not because they expect them to outperform stocks long-term, but because they provide genuine diversification and create opportunities to rebalance advantageously. Individual investors should think about them the same way. Let me also address the psychological dimension of owning long-duration bonds, because I think this is underappreciated. There's enormous psychological value in knowing you have a portion of your portfolio generating guaranteed income regardless of what markets do. When stocks are volatile, when headlines are scary, when your friends are panicking about their 401 kiloseconds, you can look at your treasury holdings and know they're going to pay 4.5% like clockwork for 30 years. That's emotionally stabilizing in ways that are hard to quantify but deeply valuable. I've seen this with institutional investors repeatedly. During periods of market stress, 2008, 2011 European crisis, 2020 pandemic, the investment committees that had substantial treasury allocations were calmer, more rational, more able to make good decisions precisely because they had that stable ballast in their portfolios. They weren't forced to sell equities at the bottom to meet liquidity needs because they had reliable income from treasuries. Individual investors need this psychological stability even more than institutions do. Institutions have professional risk management teams, diversified portfolios, governance structures. Individuals have themselves, their emotions, their cognitive biases. Having a meaningful allocation to guaranteed return assets like long-duration treasuries provides psychological fortitude to stay disciplined during inevitable periods of market turmoil. This is part of why I'm so frustrated that retail investors are ignoring this opportunity. It's not just that they're missing a favorable risk-reward on the bonds themselves. They're missing the portfolio construction benefits, the rebalancing opportunities, and the psychological stability that long-duration treasuries provide, all of which contribute to better long-term investment outcomes. Now let me address a specific objection I hear frequently. Larry, why would I buy a 30-year bond when I can get 4.8% in a money market fund right now with full liquidity and no price volatility? This is a very common question, and it reflects a fundamental misunderstanding of the opportunity. Money market funds are yielding 4.8% or so right now because the Fed has short-term rates elevated to fight inflation. But those rates are temporary. As the Fed cuts rates over the next 12 to 24 months, money market yields will fall. They'll go to 4%, then 3.5%, then 3%, then wherever the Fed takes the federal funds rate in the new rate regime, probably 2.5% to 3% long-term. So yes, you can get 4.8% today in a money market fund. But in 2 years, you'll be getting 3%. Meanwhile, the person who bought a 30-year treasury at 4.5% is still getting 4.5% and will continue getting 4.5% for 28 more years. Over a 30-year period, the cumulative return from locking in 4.5% is vastly higher than getting 4.8% for 2 years followed by 3% for 28 years. Plus, when rates fall, the treasury bond appreciates in market value. The money market fund doesn't. So you're comparing temporary high yield with no appreciation potential versus slightly lower but permanent yield with substantial appreciation potential. The long-duration treasury wins that comparison easily for long-term investors. The money market fund makes sense for money you need in the next year or two, for emergency funds, for short-term liquidity. But for long-term wealth building and retirement income, the 30-year treasury is superior. You're locking in today's elevated yields before they disappear. Finally, let me discuss the interplay between treasury bonds and other fixed income assets, corporate bonds, municipal bonds, mortgage-backed securities. The question is, if you're going to allocate to fixed income, why treasuries versus higher-yielding alternatives? The answer is risk-adjusted returns and correlation structure. Yes, you can get 5.5% or 6% on investment-grade corporate bonds versus 4.5% on treasuries. But corporate bonds have credit risk. Companies can default, get downgraded, face financial stress. During the 2008 crisis or the 2020 pandemic, corporate bond spreads widened dramatically. Prices fell even as treasury prices rose. Corporate bonds don't provide the same safe haven, crisis performance characteristics as treasuries. Similarly, municipal bonds offer tax-exempt income, which is attractive for high tax bracket investors. But munis have credit risk, liquidity risk, and in some cases significant state and local fiscal stress, as I discussed in another context. You're taking risks that don't exist with treasuries. For true portfolio ballast, for genuine safety, For assets that will perform when everything else is falling apart, treasuries are unique. That's why institutions treat them as the foundation of fixed income allocations, not as an afterthought to higher yielding alternatives. The extra yield on corporates or munis doesn't compensate for the loss of crisis performance and perfect negative correlation to equity risk. This is the analytical framework institutions use, and it's the framework individual investors should use. Allocate to treasuries not because they offer the highest yield in fixed income, but because they offer the right combination of guaranteed return, crisis performance, duration management, and portfolio diversification. That combination, at 4.5% for 30 years, is exceptionally valuable right now. Let me bring this to a practical conclusion by giving you a specific framework for deciding whether and how to act on the treasury bond opportunity I've described. Because awareness without action doesn't create results. And the window for capturing 4.5% risk-free for 30 years is closing, not tomorrow, but over the next 6 to 12 months as rate dynamics evolve. Start with a simple self-assessment based on 3 questions. What's your time horizon? What's your risk capacity? And what's your current fixed income allocation? If your time horizon is 10 years or longer, meaning you don't need access to the capital for a decade or more, you have the duration to benefit from long-term bonds. The price volatility that scares people with short time horizons is irrelevant when you're holding for 10, 20, or 30 years. You can ignore interim fluctuations and focus on the cumulative return from locking in 4.5% for decades. If your risk capacity is moderate to conservative, meaning you need stability and predictable income more than you need aggressive growth, long-duration treasuries at current yields are almost tailor-made for you. You're getting a guaranteed real return of approximately 2% to 2.5% above expected inflation with zero credit risk. For conservative investors, that's exceptional. And if your current fixed income allocation is sitting in money market funds, short-term bonds, or bond funds with average maturities under 5 years, you're leaving significant opportunity on the table. You could extend duration, lock in today's yields before they fall, and position for both income and capital appreciation. Now, based on these questions, let me outline specific action steps for different investor profiles. Profile 1. Pre-retiree with 5 to 15 years until retirement, moderate risk tolerance, $500,000 to $2 million portfolio. You should be thinking about creating a treasury ladder that starts maturing around your retirement date. Take 20% to 30% of your total portfolio, let's say $300,000 if you have $1 million, and build a ladder of treasury bonds with staggered maturities. Some 10-year, some 15-year, some 20-year, some 30-year. This accomplishes several things. You lock in current yields across the curve before they fall. You create predictable cash flows that can fund early retirement years without forcing you to sell stocks in a down market. And you position for capital appreciation if rates decline, which gives you optionality at retirement. You can sell the appreciated bonds and reallocate, or hold them for continued income. Execute this over the next 3 to 6 months. Don't try to time it perfectly. Rates might tick up or down by 20 or 30 basis points, but that's noise relative to the strategic value of locking in today's yield environment. Pick your maturities, decide whether to buy individual bonds or use ETFs, and execute the allocation. Profile 2. Retiree already drawing income, conservative risk tolerance, $1 million to $5 million portfolio. You need reliable income with minimal volatility. Consider allocating 40% to 50% of your portfolio to a combination of intermediate and long-duration treasuries. Maybe $400,000 in intermediate treasuries, 5 to 10-year maturities, for stability and near-term liquidity, and $400,000 in long-duration treasuries, 20 to 30-year maturities, for higher yield and appreciation potential. The intermediate bonds provide a cushion you can draw from or sell if needed without worrying about price volatility. The long-duration bonds provide higher income and position you for gains if rates fall, which improves your overall portfolio return and helps offset inflation over a potentially 25-year retirement. The remaining 20% to 40% of your portfolio can be in dividend stocks, REITs, or other income-oriented assets for growth and inflation protection. But the Treasury Foundation gives you the stability to weather market volatility without panic. Profile 3. Younger accumulator, 20 to 25 years from retirement, higher risk tolerance, aggressive growth focus. You're probably thinking you don't need bonds at all. You're 100% stocks and that's fine for now. But consider this. Allocate just 5% to 10% of your portfolio to long-duration treasuries as asymmetric protection. With a $500,000 portfolio, That's $25,000 to $50,000. Buy a long-duration Treasury ETF or individual 30-year bonds. In normal markets, you're collecting 4.5% and compounding that income. In crisis markets, the inevitable recessions and panics that will occur over the next 25 years, those bonds will surge in value precisely when your stocks are getting crushed, providing portfolio balance and rebalancing opportunities. This isn't about maximizing returns. It's about improving risk-adjusted returns and building resilience into a portfolio that's otherwise entirely equity-dependent. The opportunity cost is minimal. 5% to 10% of your portfolio earning 4.5% instead of hypothetical 10% equity returns. The benefit is meaningful downside protection when you'll need it most. Profile 4. High net worth individual, $5 million plus portfolio, sophisticated tax situation. You have the portfolio size to implement more nuanced strategies. Consider building a substantial treasury ladder, $1 million to $2 million, spanning 10 to 30 years in maturity. Use individual bonds for precision and control. Also consider the tax angle. If you're in a high state tax bracket, the state tax exemption on treasury interest is valuable. A 4.5% treasury yield is equivalent to 5% plus on a fully taxable bond for someone in California or New York paying 10% plus state tax. That makes treasuries even more compelling relative to corporate bonds or other taxable fixed income. You might also consider using treasury bonds as collateral for other strategies, borrowing against them at low rates to deploy in other opportunities while maintaining the treasury position for its income and diversification value. This is more advanced, but it's worth discussing with advisors. Now, let me address the timing question that I know many of you are wrestling with. Should you buy now, or wait to see if rates go higher and you can get better yields? This is the classic investor dilemma, fear of missing better entry points. Here's my answer. If your time horizon is measured in decades, trying to time a 20 or 30 basis point improvement in yield is false precision that costs you opportunity. Yes, maybe yields tick up to 4.7% or 4.8% at some point. But maybe they don't. Maybe they fall to 4% over the next 6 months as the Fed cuts rates and the economy slows. Then you've missed 4.5% waiting for 4.7% and ended up buying at 4%. The right approach for long-term strategic allocation is to build the position over time. Maybe allocate 1/3 of your intended treasury position this month, 1/3 in 3 months, 1/3 in 6 months. This gives you dollar cost averaging into the position while ensuring you capture some of today's yield environment rather than risking being entirely shut out if rates fall quickly. But don't wait indefinitely for perfect certainty. The point of strategic asset allocation is that you're positioning for a range of outcomes, not trying to predict the exact path. If you believe, as I do, that the most likely trajectory for long-term rates over the next 3 to 5 years is lower, then today's yields represent opportunity regardless of whether they're precisely at the peak. Let me also address the question of active versus passive implementation. Should you buy individual treasury bonds and hold them to maturity, or should you buy treasury bond ETFs and actively manage the position based on rate expectations? For most individual investors, I recommend individual bonds held to maturity for the core allocation. This provides certainty. You know exactly what you'll receive in interest payments and principal return. You're not subject to fund management decisions or mark-to-market volatility that might tempt you to sell at the wrong time. You can ignore the daily price fluctuations and focus on the guaranteed income stream. ETFs make sense as a tactical overlay if you want some additional duration exposure that you might adjust based on changing market conditions. Maybe 80% of your treasury allocation is in individual bonds you're holding forever, and 20% is in a long-duration ETF that you might trade around based on opportunities. This gives you the stability of the individual bonds plus some tactical flexibility with the ETF. But avoid the trap of trying to actively trade in and out of long-duration treasuries based on rate predictions. You're not going to consistently outsmart the market on rate timing. The professionals who did this full-time with teams of economists and sophisticated models still get it wrong regularly. Your edge as an individual investor is patience and long-term thinking, not short-term trading. Now let me address what I think will happen over the next 12 to 24 months, because understanding the likely path helps contextualize the opportunity. My base case is that the Fed continues cutting short-term rates as inflation moderates and growth normalizes. The federal funds rate, currently around 4.5%, probably goes to 3.5% to 4% by end of 2025 and potentially to 3% or lower by 2026 if the economy slows meaningfully. Long-term Treasury yields will follow this path down, though not one for one. The 30-year yield might go from 4.5% today to 4% by end of 2025 and 3.5% or lower by 2026. This would produce capital appreciation of roughly 10% to 15% on long-duration bonds over that timeframe, plus you're collecting 4.5% annually. So the total return scenario for someone who buys 30-year treasuries today could be 4.5% income plus 10% to 15% capital appreciation over the next 12 to 24 months, for a total return of 14% to 20%. That's from a safe government bond. And after that initial appreciation, you're still holding a bond that pays 4.5% for the next 28 years, which is likely to look attractive relative to whatever yields prevail in 2026 and beyond. This is the opportunity that institutions see and are acting on. This is what retail investors are missing by staying in cash or short-term bonds or ignoring fixed income entirely. Of course, I could be wrong. Maybe inflation resurges and the Fed has to keep rates higher for longer or even raise them again. Maybe fiscal deficits spiral and the bond market demands higher yields to finance government borrowing. Maybe there's some exogenous shock that changes everything. But even in those scenarios, 4.5% for 30 years with zero credit risk is a reasonable outcome. You're not getting hurt in any scenario short of sustained high inflation above 5% for years, which seems unlikely given current conditions. The asymmetry of outcomes, significant upside if rates fall, modest downside if rates stay elevated, favors taking the position. Let me end with the bigger picture of what this moment represents. We've been through an unprecedented 15-year period of financial repression where central banks pushed interest rates to zero and in some cases negative. Savers were punished. Conservative investors couldn't earn acceptable returns without taking significant risk. Retirees were forced into equities and high-yield bonds just to generate income. That era is over. We've normalized. Interest rates are back to levels that allow for traditional portfolio construction where bonds play their proper role, providing stable income, diversification from equities, and ballast during market stress. But we're in a transition period where rates have normalized but haven't yet fallen back to artificially suppressed levels. This transition period, which we're in right now, is the opportunity. It's the brief window where you can lock in 4.5% risk-free before the next recession or crisis drives rates back down. In 5 years, we'll look back at 2025 as the moment when prescient investors locked in generational yields, and everyone else missed it because they were distracted by stocks or real estate or crypto or whatever the narrative of the moment was. I've spent my career identifying these moments, the brief windows when market dislocations or transitions create opportunities that seem obvious in hindsight but are ignored in real time. The financial crisis in 2008 created opportunities in distressed debt and equities that were generational. The European debt crisis in 2011 created opportunities in European bonds that were extraordinary. The pandemic in 2020 created opportunities across asset classes that minted fortunes for those who acted while others panicked. This moment, long-duration treasuries at 4.5% in early 2025, is that kind of opportunity. Not as dramatic as those crisis-driven dislocations, but meaningful and time-limited. The institutions that manage the largest pools of capital in the world recognize it and are acting on it. Individual investors should be doing the same. So here's my challenge to you. Look at your portfolio. Look at your fixed income allocation. Ask yourself whether you're strategically positioned for the next 10 to 30 years, or whether you're drifting with whatever happened to be in your account when rates were at different levels. Ask yourself whether you're being proactive about capturing today's opportunity, or whether you're going to look back in 5 years and realize you missed something obvious. And if you conclude that you should be doing something, building a treasury ladder, extending duration, locking in yields, then act. Don't wait for perfect information or perfect timing. The nature of opportunities is that they're time-limited. By the time everyone agrees it was a great opportunity, the opportunity is gone. The smartest money in the world is buying long-duration treasuries right now. You should be asking yourself why you're not doing the same. And if you don't have a compelling answer to that question, if you're just defaulting to whatever you've been doing because that's what you've been doing, you're making a mistake that will cost you returns over the next several decades. The opportunity is here. The window is open, but it won't stay open forever. Rates will fall, yields will compress, and the chance to lock in 4.5% risk-free for 30 years will disappear. Make sure that when it does, you are on the right side of the decision.